Welcome back to the SGH Opportunities Fund monthly update. I'm Rory Hunter, and with me as always is Sophie Smith. Soph, welcome back, how are you?
Hey Rory, going well. We are here today to discuss March, a month that has already thrown up big developments across the ASX, particularly in gold, electrical services and strategic metals. A few portfolio changes on our end too, so I'm keen to unpack it all today.
Yeah, absolutely. So firstly, just on performance, it was another good month of absolute and relative returns. So the portfolio eked out a small positive return, up 0.5%, which was just over 4% above the benchmark, which was down 3.6%. So moving to company-specific news first, we'll start with the headline news. So Ramelius Resources merging with Spartan Resources to create one of the ASX's next large-cap gold producers. The deal sets the group on track to hit about 500,000 ounces per annum by FY30, with an industry-leading all-in sustaining cost margin.
The deal's a mix of cash and script, valuing Spartan at around $1.78 per share. From a shareholder perspective, Spartan investors get 25 cents cash and 0.7 new Emyria shares for each Spartan share. Once it's done, likely by late July or early August, Emyria shareholders will own 60.5% of the merged company, with Spartan holding 39.5%.
Yeah, so what we really like here is the strategic fit. Ramelius brings operational experience, a solid track record and low-cost producing assets. Spartan, meanwhile, adds high-grade development assets to what was a declining production profile. The potential synergies are also going to surprise the market, in our opinion.
And those margins really matter. So Ramelius already runs with a healthy all-in sustaining cost margin, which gives them strong free cash flow, a huge advantage as they absorb Spartan's development projects. Plus, they're promising a feasibility study and 10-year outlook by the end of 2025, which will be a major re-rating catalyst for the stock.
Yeah, so we've actually re-entered our Spartan position on the back of this news. And also, if we see a bit of a price pullback, we'll look to build the position further. The combined business really has the makings of a producer that is deserved of a premium valuation. So let's pivot to another smart acquisition. Southern Cross Electrical, that's ASX ticker SXE, acquiring Force Fire Holdings.
This seems to be a really savvy acquisition. At $36.3 million in upfront costs, potentially rising to $53.5 million if EBIT targets are hit for FY26 and 27. So Force Fire operates in New South Wales and Queensland, specialising in fire detection and safety systems. And they're budgeting $106 million in revenue and $8.3 million in EBIT for FY25.
Yeah, so that means an 18% EPS uplift for Southern Cross based on a 4.8 times EV/EBIT multiple. What we like here is the recurring nature of Force Fire's revenue. About 30% comes from services and maintenance, which really adds to the sort of reliable profitability of Southern Cross Electrical.
Plus, Force Fire covers both wet and dry fire systems, so mechanical and electrical. So they're really showing capability breadth. Southern Cross has already flagged cross-selling opportunities and targeting at least 10 mil of EBIT by FY26 from the new division.
Yeah, so it's a bolt-on that really makes perfect sense and funded through cash reserves, no debt, and well aligned with their existing client base. With the Southern Cross margin profile at 6% and Force Fire running at 7.8%, there's also decent potential to really improve the group profitability. So moving on to sort of the thematic side of things now, our strategic metals positions have continued to do really well. And they've really been boosted by rising European defence spending, which we think is a thematic that's very unlikely to go away anytime soon. Lavato Resources, so that's ASX ticker LRV, was up another 33% for the month. And Astronaut Industries, that's ASX ticker AII, was up 18% for the month.
A big tailwind here has been the EU's Readiness 2030 defence plan, announced by Ursula von der Leyen, which commits €800 billion to military capability upgrades. That's put a rocket under defence-exposed names, excuse the pun.
Yeah, exactly. So European contractors like Rheinmetall, Leonardo, BAE Systems and Thales all posted double-digit gains for the month. Rheinmetall was up 14%, Leonardo up 16%. And the macro environment is shifting really fast. Strategic metals like tungsten and antimony are reasonably seen as part of the defence supply chain.
That dynamic's not going away anytime soon either. And what about changes to portfolio positioning this month?
Yes, we've done a little bit of trimming. So Lavato's had a great run, but the upcoming DFS is as much a sort of risk event as it is a catalyst. We've also cut our position in Generation Development Group. So GDG has been a top performer, and especially after index inclusion into the Small Ords. But the valuation's starting to look really stretched, and it's quickly becoming quite a crowded trade.
And we also sold some Genesis Minerals, ASX GMD, right?
Yeah, so we've rotated out of the Genesis position and into Spartan, which we basically see as having a much better risk return profile given the Ramelius tie-up, but also the relative valuations. We think that the combined entity of Ramelius and Spartan is looking very cheap, whilst Genesis, the valuation is looking quite stretched. On the buy side, we added to Botanic's Pharma after a pullback that we thought was very unwarranted.
And for clarity, Botanic is commercialising a dermatology asset for hyperhidrosis treatment, right?
Yeah, so Botanic's offered no commercial updates in their first half results, which spooked the market a little bit. But from our understanding, sales are progressing really well, and management actually remains confident about getting to break even on their current cash. As a result, we're really backing them in. So really just to wrap it up, Ramelius and Spartan are creating a really compelling new gold mid-cap producer. Southern Cross adds stable cash flow via force fire, and we've been busy rebalancing the portfolio to stay ahead of shifting macro themes.
So there's plenty of opportunities out there, and the macro environment demands an agile portfolio positioning strategy.
Yeah, that's right, Soph. We'll be back next month with more market insights and updates from the portfolio. So until next time, thanks very much for tuning in to the SGH Opportunities Fund monthly update. This update has been recorded on the 3rd of April 2025.
This update has been prepared by SG Hiscock and Company Limited to provide you with general information only. In preparing this update, we did not take into account the investment objectives, financial situation, or particular needs of any person and is not investment advice. Equity Trustees Limited is the responsible entity for the SGH Opportunities Fund. Neither SG Hiscock and Company Limited, Equity Trustees, nor any of its related parties, their employees or directors provide and warranty the accuracy or reliability in relation to such information or accepts any liability to any person who relies on it. Past performance is not an indicator of future performance. You should obtain a copy of the information memorandum before making a decision about whether to invest in this product available on the SG Hiscock website.